I'm Kush Motiani from Agility Innovations. For the next few minutes, I want to walk you through a project that we delivered for a client that who works in the insurance industry. They insure home loan borrowers. So if a borrower dies, the policy clears the outstanding loan. What we built for them predicts those death claims and then converts that prediction into an actual price they can charge. That second half is the part that matters and it's where we will end up. So here's the situation we walked into. Every borrower who gets covered is charged a rate per lakh of cover. The rate came off a fixed table, indexed by age and loan tenure. That is a standard practice. The problem is nobody had ever gone back and checked whether that table agreed with the claims that book was actually providing. So on the left, these are the questions they couldn't answer. What should a 20-year-old on a 15-year loan actually should be charged? Which segments are being written below the cost of their own claims? Which schemes need repricing at renewal? And on the right is why it's hard. You can't price a claim until you can predict one. And death claims are rare events. The risk also changes shape as a book ages. So one flat rate is wrong at both ends. And the moment you cut the data fine enough to price precisely, most of your segments go too thin to trust. So, quick summary before the detail. Around 11 million member records going in, 21 engineered risk signals behind every prediction, 5 experience-based rates coming out, replacing one flat assumption, and 298 schemes scored and graded for the repricing. The line I would underline is the one at the top, raw data in, a quotable rate out. This is one pipeline, not a model sitting in a notebook that somebody then interprets by hand. So here's the architecture. There are 6 stages that are fully automated. It starts with the client's raw data, actually exactly as their own system holds it. They don't have to clean anything or prepare anything for us. The stage one takes the raw data and turns the whole book into one clean, consistent data set. No manual work on their side. The stage three is the claims engine. That's the prediction how many claims a scheme is expected to produce. And the stage four is where most projects like this stop short. The pricing engine takes that prediction and turns it into money, a rate per lakh of cover the client can actually quote. That's the whole point, and that's where it will end up. And these are what client actually gets out of it. A rate per lakh by segment, a 10-year claim forecast, and a list of which segments to reprice. 3 concrete deliverables, not a module they have to go and interpret. So, what the model reads first. The first family is who the borrower is, like the age mix, gender mix, how many are the new joiners. This is where the single strongest driver in the whole book lives. The share of borrowers past 60 because mortality climbs steeply after that point. The second is how that loan is structured. Tenure, how far along the loan is, whether it's a loan against property. This governs how long we are on a risk and how much it's genuinely at a stake. The third is where they are, that is the state, region, and the claim history of the originating branch because both mortality and lending practice differ sharply across the country. And the fourth, this is how the scheme behaves, how old it is, whether it's still growing, what it's already being charged. This is the family that lets the model treat a 2-year-old scheme and a 9-year-old scheme as the genuinely different risks they are. The point of showing it this way is that when the client asks why is segmented price the way it did, we can answer in plain English. There's no unexplainable box in the middle. So this is the claim engine. This is the engine that produces the number everything else is built on. There are 2 models running. The first learns the shape of how claims emerge as a scheme gets older, borrowed from schemes with a similar profile. The second sets the level for that specific scheme from its own set of underwriting signals. If I go all the way left, that's a pure experience curve. It has the right shape, but it does not know anything about this particular scheme. If I go all the way right, it's a pure regression. What's the accuracy number? Bottom right. It drifts off the target. And what if I drag it in the middle? It's the actual over expected 1.00. One is perfect, and that's what we are trying to hit. Now the number is produced as a claim. So let me take you to the life cycle window. At year one, scheme runs at about 1.75 claims per thousand. By year 10, it's over 6. That's more than triple. Two things are happening. The borrowers are getting older and the healthy ones are repaying early and leaving, which concentrates the pool that stays behind. So we fit the model in three overlapping windows across the life cycle: early, mid, and late. And they deliberately overlap at year 7. So the handover between windows is something the model learns rather than something we assume. So here comes the validation part. You can't price off a prediction you haven't tested. So this is the slide that earns the trust. The white dots are what actually happened, the real claims year by year. The green line is what the model predicted, and they lie right on top of each other the whole way across the life cycle. The prediction lands on the actual pool across the whole book. Prediction is within 2% of what actually happened. In the late years, where most of the money is, it's within 1%. And the important part is how that's measured. Every one of these numbers is on the schemes the model never saw while it was learning, so it's not marking its own homework. It's being tested on a new business, which is exactly with what it will face in the production. Then comes the pricing engine. So let me take you the step one, that this is the claims engine that gives us the expected claim rate for the segment. And no, that's the fitted rate, not the raw historical ratio. So a segment with an unlucky history doesn't carry its own noise into the price. Let me take you to step two. This is the one that changed everything. Exposure is counted in life years of actual cover, never in members. I'll spend a full slide on this next. Let me take you to step three. That applies that to a standard lakh of cover. 132 rupees, that's pure risk cost. What we expect to pay out on every lakh we cover in this segment. Step 4, credibility weighing. If you cut the book to single years of ages and the tenure, most cells hold too few claims to mean anything. So each band gets weighted toward the pool book rate in proportion to how much real experience sits behind it. A thin segment can't influence its own price, it can't dictate it. Step 5. And step 5 loads it to the for the margin, 158 rupees per lakh. That's the number an underwriter can quote, and every step of it traces back to the claim that actually happened. Let me show you the 5 to 10 year, 10 to 15 years, 15 to 20 years. These all change and all the steps are given to us. So now this is the single most valuable thing we found on the project. The claim rate was previously being derived by dividing claims by the number of members. That gives you 0.57 per thousand. We counted exposure in life years instead. Same claims, exactly the same things, different denominator, 1.33. That's 2.3 times higher. The reason is simple. A borrower who joined in October was only covered for a quarter of that year. Count them as a whole life and you inflate the denominator and apparent the claim rate. And a fast growing book is full part year members. So the faster the book grows, the more badly it understates its own risk. Every rate built on the headcount was priced to lose money. Nobody had spotted it because the arithmetic looks perfectly reasonable until you ask what the denominator actually means. And this is what comes out at end to end. Five tenure bands, each with a rate built from the book's own claims. Gray bar is what they charge today. Colored bar is what their claims experience say they should charge. This one is finding the 5 to 10-year band is producing claims about 24% above what it's currently charged for. That's business being written below cost, quietly at volume. And the long tenure bands are the opposite problem, priced above their own experience, which means business being turned away for no good reason. Neither of those is visible if you look at the book as one number. The overall loss ratio looked fine. The problem was entirely inside the mix. So here's the calculator, and once that's built, pricing any individual member takes three moves. Age of the borrower, you can see the whole grid on the left getting darker as the risk climbs. Loan tenure, and watch the box at the bottom. Red means the current card is charging below what it actually should. Push the tenure out and it flips green. That's the headroom. They should compete harder on the rate in that segment without losing money. This is the practical output, not a report, a tool somebody in the pricing team opens and uses. We can easily adjust the borrower age, like 25 years old for a loan of 8 years. Well, what is the loan amount? 35 lakh, and you can easily get the current card premium and the experience-based premium they should have charged. So, same engine pointed at the existing book instead of at new business. Every scheme is graded against schemes like it. Similar age profile, similar tenure, similar loan mix. Red means the claims are running well about the comparable schemes, and that's repricing conversation at renewal. Amber is above its peer group, but inside normal variation. So watch it, don't act on it. Green is performing as expected. The important word there is peers. A small scheme with one unlucky claim looks catastrophic on the raw ratio. Compared against schemes of its own size and shape it usually doesn't. That distinction is the difference between a useful triage list and a spreadsheet nobody trusts. So here's our final output. That's our dashboard. And this is the delivered product, not a slide deck. And this is what the actuarial team opens. They pick a scheme and see who's actually in it, age bands, tenure mix, loan sizes, the 10-year projection, the 10 years of history behind, the 10 years of forecast ahead on one plane. The dotted line is where the actual stop and the prediction starts. Accuracy deep dive, how closely the prediction has tracked actual claims so the team can see for themselves how much to trust it. The exit and the foreclosures. And this one is worth a mention. It shows when a member leaves, healthy borrowers foreclose early, which means the pool that stays behind is systematically less healthy. If you ignore that, late life claim rates look like deterioration when part of it's just a selection. We measure it, then we absorb it. This is the model insights which shows the features, the vintage cohorts for the FY years. Everything is inside this dashboard. So where this lands us, five earned rates behind 104 and 198 rupees per lakh, replacing a single inherited assumption. One tenure band identified as writing business a quarter below cost. The exposure correction more than the doubled the measured claim rate, feeding every price. Accuracy of 1.0 on one data the model never saw. 298 schemes graded for renewal and a full rebuild on a fresh data cut in under an hour with no manual steps. So that's our project built end to end by our team. The data pipeline, the signals, the claims model, the pricing engine, and the console the client uses every day. And it's in production on a live book. It's not a proof of concept sitting in a notebook. The pattern transforms any portfolio with member level history and a claim record can be priced this way. Health monitor, group term, it's same problem with different variables. If you're sitting on a book and you are not certain the price you are charging matches the claim you are paying, that's exactly the conversation we would like to have. For if you need to build any project like this for any segment, do contact us. Thanks for watching this video. Thank you guys.